Hello everyone and welcome to AUSTRAC's webinar on Australia's National Risk Assessment of Money Laundering, Terrorism Financing and Proliferation Financing. My name is Nick. With me today is Michelle. We are all part of AUSTRAC's Industry Education and Outreach team, and we will be taking you through the findings of the risks posed to the Australian sectors, such as yours, through money laundering, terrorism financing and proliferation financing. For the remainder of this presentation, I will refer this to as MLTF and PF. AUSTRAC acknowledges the traditional custodians of country throughout Australia and their continuing connection to land, sea and community. We pay our respects to elders past and present and extend this respect to all Aboriginal and Torres Strait Island people joining us today. Thank you all for taking the time to join us. The purpose of today's session is to provide you with the contextual information on the scale and impact of the risks associated with MLTF and PF. This is information you need to meet your key compliance obligations under the AML-CTF Act. Understanding these risks is crucial in implementing effective systems and controls to protect your businesses and the greater community from criminal abuse. This webinar highlights some of the key findings of the national risk assessments that may be relevant to your business, but we won't cover all the information included in the national risk assessments. We encourage you to read these for a more fulsome understanding of the money laundering, terrorism financing and proliferation financing in Australia, as well as the specific vulnerabilities that may be relevant to your business's MLTF and PF risk. This webinar should not replace or form part of your staff AML-CTF risk awareness training program. This July, AUSTRAC published two new national risk assessments, one on money laundering and one on terrorism financing in Australia. In December 2022, AUSTRAC published a national risk assessment on proliferation financing. Proliferation financing is when a person makes available an asset, provides a financial service, or conducts a financial transaction that is intended to facilitate the proliferation of weapons of mass destruction, regardless of whether the activity occurs or is attempted. These risk assessments are an important contribution to Australia's anti-money laundering and counter-terrorism financing or AML-CTF regime. They bring together insights from across Australia's national intelligence community, law enforcement and regulatory agencies, private sector stakeholders and international financial units to provide a contemporary, consolidated picture of Australia's risk environment. They also highlight where efforts to combat money laundering, terrorism financing, and proliferation financing can be improved. AUSTRAC completed these national risk assessments as Australia's financial intelligence unit. However, we would like to acknowledge that over 50 partner agencies who made important contributions to the risk assessments, including law enforcement, intelligence agencies, regulators, social services, and taxation authorities at the Commonwealth and the state level. So when it comes to developing or updating your business's money laundering and terrorism financing risk assessment, you must take into account AUSTRAC's guidance and feedback that is relevant to your business's money laundering and terrorism financing risks. This includes relevant information from the National Risk Assessment. The information in the National Risk Assessment and today's webinar is important to consider as it may alert you to risks that you were not aware of. Levels of risks are constantly changing, as are the crimes that generate illicit funds for MLTF and PF activity. The risk assessment provides a national and a sector-wide view of MLTF-PF risks based on the information not available to individual businesses or organizations. National or sector-wide MLTF risks may impact on the particular MLTF-PF risks faced by your business or organization. Throughout today's webinar, you should consider how the information presented is relevant to your business. I will now hand you over to Michelle to take you through the next few slides.
Thanks, Nick, and hello, everyone. We'll begin today's session by discussing the Money Laundering National Risk Assessment. Money laundering is a major component of almost all criminal activity, and criminals continue to identify and exploit new opportunities to launder illicit funds through innovation, experimentation, and adaptation. Australia has a global reputation as a large, robust and stable economy, which makes it an attractive destination for foreign proceeds of crime. Our strong trade and investment ties also create vulnerabilities that are exploited by criminals. For example, asset classes that attract a high volume of international investment, such as real estate, are also highly desirable as a means to transfer and store wealth. In the context of this risk assessment, money laundering threats refers to predicate crimes that generate illicit proceeds, which are then laundered in, from, or through Australia. A predicate crime is any offence that generates proceeds of crime. You will see on the next slide a list of predicate crimes, which have been rated high, medium, and low. An explanation of these ratings is currently on the screen, so just take a moment to read through those. As well as ratings, on the next slide you'll also see an outlook assessment for each threat, which looks at the next 3 years. An explanation of each outlook rating is also included on the next slide. 3 of the highest money laundering threats identified in the risk assessment are illicit drugs, tax and revenue crime, and government-funded program fraud. So firstly, the domestic illicit drug market is assessed as posing a high and increasing money laundering threat. Australia's illicit drug market generates significant volumes of criminal proceeds that require laundering. Well-established money laundering methodologies continue to persist, such as the structuring and use of cash, the use of third-party accounts, and the use of money mules. There may be red flags you can include in your transaction monitoring program or employee risk awareness training to identify these methodologies. Then secondly, we have tax and revenue crime, which also poses a high and increasing money laundering threat. Many of the channels and criminal methodologies that are used to commit tax and revenue crimes are also used to launder the resulting criminal proceeds. For example, professional service providers such as lawyers or accountants are used to establish onshore and offshore business structures and banking arrangements to hide transactions, assets, and beneficial ownership. This is why reporting entities must identify the beneficial owners of their customers and assess the risks that they pose. Thirdly, we have government-funded program fraud. Once again, this poses a high and increasing money laundering threat. Like tax and revenue crime, money laundering techniques are essential to layer and reintegrate criminal proceeds generated from government-funded program fraud. Fraudulent activity often involves inflating or falsifying invoices, overclaiming for services delivered, using stolen personal information to claim additional benefits, and using people with no criminal record to act as company directors, and lastly, illegal phoenixing. Phoenixing occurs when a new company is created to continue the business of another company that has been deliberately liquidated to avoid paying its debts, including taxes or employee entitlements. Identifying your customer's source of funds and source of wealth provides you with useful indicators on whether a customer's funds or wealth may come from criminal activity, and will help you assess and manage your risks. In collaboration with the National Disability Insurance Agency, AUSTRAC released a financial crime guide in 2020, which includes indicators that can help you identify, monitor, and report suspected fraud against the NDIS. Additionally, scams are assessed as posing a medium and increasing money laundering threat. This includes scams relating to romance, investments, threats and extortions, employment, and unexpected money. Money laundering techniques are required to layer and transfer the proceeds of scams to the offenders. Some of the key methodologies identified for scams include the use of mule accounts, impersonating phone numbers, email addresses, or websites of legitimate organisations, and creating fake ads, social media profiles, and reviews. The use of digital currencies as a payment method has also increased significantly in recent years. Sadly, Australians aged 65 and over were the most commonly targeted victims, as well as vulnerable members of the community, such as Indigenous Australians, members of culturally and linguistically diverse communities, and people with a disability. Again, these are red flags that should be included in your transaction monitoring program and your employee risk awareness training. If your transaction monitoring program or employees are not identifying these methodologies, you should ensure that you have an up-to-date risk assessment, that you've reviewed what transactions or activity you're monitoring for, and that you train your staff to help them detect suspicious transactions. I'll hand you back to Nick now, who'll discuss vulnerabilities.
Thank you so much, Michelle. Well, money laundering vulnerabilities exist across multiple levels, including national, sectoral, and channel levels. The risk assessment assigns a risk rating for the overall assessment of money laundering vulnerabilities for a number of sectors and channels. Channels refers to the way in which money is being laundered, for example, through cash-intensive businesses or through remote delivery channels, such as ATMs, internet, and phone banking. You will see on the next slide a list of sectors and channels which have been rated from very high, high, medium, low, and very low in terms of their money laundering vulnerabilities. On this slide, we have an explanation of these ratings. I'll give you a moment to read through them. Today, we will be discussing some of the higher risk sectors and channels. Some of the sectors identified in the risk assessment as facing the highest money laundering vulnerabilities are major, domestic and foreign subsidiary banks, casinos, and remittance service providers. Despite efforts by industry and Australian authorities, many of the most significant money laundering channels identified in Australia's Money Laundering National Threat Assessment of 2011 still persist today. The banking sector is assessed as continuing to pose a high and stable money laundering vulnerability. Given their central role in the Australian economy and the global payment ecosystem, most money laundering activity will intersect with reporting entities in the banking sector at some point in the transaction chain. Transaction accounts are key transit points in and out of the banking system, making them the most commonly and persistently misused product. They are highly exposed to cash placement, enable fast layering activity domestically and internationally, and provide accessible low-cost fund storage. Accounts can be established quickly and easily online, a feature exploited by criminals using stolen, rented, or purchased identities to create mule accounts to launder money. Technological innovations have increased transactional speed and convenience in the recent years. The rollout of the new payments platforms, the NPP, allows for near real-time transfers. And the exploitation of multiple NPP-enabled accounts across different banks makes it difficult to trace transactions, to investigate and prosecute money laundering offenses. Additionally, the increasing reliance on remote delivery channels such as ATMs, internet, and phone banking provides criminals with convenient and sometimes anonymous methods to launder money. We will now discuss the findings of the risk assessment for each of the subsector in the banking sector, starting with the major banks. Major banks are assessed as posing high and stable money laundering vulnerability. Major banks are the largest financial institution in Australia and are almost certainly exposed to the majority of money laundering risk facing the banking sector. Given the size of their customer base, scale of operations, cash transaction infrastructure, and global reach, major banks offer the most extensive and accessible cash transaction infrastructure in Australia, facilitated more cash transactions than all other regulated sectors combined. Major banks are also the key conduit for international transactions in and out of Australia and serve as correspondent banks for other financial institutions as well. These links to offshore institutions and customers expose them to a high level of foreign jurisdiction risk. They also offer products that are exploited to quickly place and layer criminal proceeds across multiple financial institutions, both in Australia and offshore, as well as the products that can be used to integrate criminal proceeds such as purchase of high-value assets and real estate. Given these features, they remain highly vulnerable to money laundering methodologies such as the use of money mule networks, cuckoo smurfing, accounts owned by shell companies or cash-intensive businesses, and using banking products to store funds used for offsetting purposes. Sophisticated money launderers often combine methods and the use of expertise of professional service providers to help conceal their illicit activity. Some major banks had failures in their AML systems, controls, and systems in recent years. As a result, ongoing significant investment in their AML CTF programs are being made. They report more suspicious transactions than any other financial sector, providing significant amount of financial intelligence to law enforcement and intelligence bodies. It is important to make sure your transaction monitoring program is able to detect these methodologies and to ensure your staff are adequately trained to detect these methodologies. The risk assessments identified that major banks will continue to pose a high money laundering vulnerability over the next 3 years. Next, we'll look at other domestic and foreign subsidiary banks, which are assessed as posing a high and stable money laundering vulnerability as well. Domestic banks and foreign subsidiary banks primarily offer retail banking products. However, the nature and extent of money laundering risks across the subsector varies significantly, depending on the bank size, the types and location of customers it services, its products and services, and its global reach as well. For example, larger banks in this subsector are generally exposed to higher level of criminal exploitation. They offer more extensive and diverse products, services, and delivery channels, providing money launderers with more options to move large amount of funds. Banks that offer corporate banking products and services in addition to retail products and services are exposed to unique money laundering vulnerabilities, such as the misuse of trade finance facilities. Banks that operate branchless models or rely on third-party agents to facilitate cash transactions are exposed to heightened vulnerabilities, as these arrangements can complicate detection of suspicious persons or transactions. Foreign subsidiary banks are generally more exposed to foreign jurisdiction risk because they offer products like foreign currency exchange accounts. They are also likely favored by customers with links to offshore entities. Common money laundering methods observed that you should monitor for include the use of money mules, significant cash or check deposits, and large domestic transfers into personal or business accounts. Funds are often then transferred to other domestic or international financial institutions. The risk assessment found there is a wide variation in the effectiveness of AML-CTF system controls across the subsector, so we encourage you to make sure you have an up-to-date risk assessment and monitor that your system and controls are working efficiently. Other domestic banks and foreign subsidiary banks will continue to pose a high money laundering vulnerability over the next 3 years. Michelle will now take you through the remaining two subsectors here.
Okay, so I'm going to talk next through mutual banks, which are assessed as posing a medium and stable money laundering vulnerability. The extent of money laundering through mutual banks is moderated by the sector's limited size and reach compared to other banking sectors. Many mutual banks are able to move large volumes of funds quickly and easily. However, the subsector has fewer customers and facilitates fewer transactions than other retail banks. This makes it harder for criminals to conceal any large-scale money laundering activity among the smaller volume of legitimate transactions. The retail banking products and services primarily offered by mutual banks are highly vulnerable to money laundering. Larger mutual banks are likely exposed to a higher level of vulnerability due to their size and multiple options for products, services, and delivery channels, where smaller mutual banks that offer simple yet versatile products, such as transaction accounts, loan products, and term deposits, are also exposed. Criminal exploitation of mutual banks generally involves incoming electronic transfers from accounts held at major banks or other large domestic banks. Mutual banks that offer cash facilities are also exposed to the direct placement of illicit cash into customer accounts. Mutual banks have historically maintained regional branch networks. However, many have since reduced their physical presence and are increasingly relying on online banking for product applications and the use of third-party agents like Australia Post to facilitate cash transactions for customers. These outsourcing arrangements lengthen the service delivery chain and reduce end-to-end visibility of transactions. The risk assessment found that the effectiveness of risk mitigation strategies varies across the mutual banking sector. Some mutual banks have undergone AML-CTF capability uplift in recent years, while others may not have the resources to operate sophisticated AML-CTF systems and controls. So we encourage you to ensure that your AML-CTF systems and controls are operating effectively to identify suspicious activity. Mutual banks will continue to pose a medium money laundering vulnerability over the next 3 years. The extent of vulnerability is somewhat moderated, given the smaller size and scale of many banks in the sector. However, the retail products they offer will likely continue to be attractive for criminal exploitation. Now we'll move to foreign bank branches, which are assessed as posing a medium and stable money laundering vulnerability. Foreign banks face a distinct money laundering risk profile compared to other banking sectors, as they provide complex, customised financial products and services for cross-border trade and investment to a smaller number of high-value customers. Foreign bank branches may be attractive to sophisticated criminal threat actors with the access and expertise to establish necessary structures to exploit them for money laundering. The risk assessment identified two key money laundering vulnerabilities for foreign banks. Firstly, the exposure to higher risk customers, in particular, respondent banks and other financial institutions, high net worth individuals, including commercial companies and trusts, foreign-based customers, professional service providers, and PEPs, politically exposed persons. Then secondly, the products and services that can be used to store and move funds into and out of the subsector, such as accounts including transaction, savings, and foreign currency accounts, international funds transfers, and correspondent banking services. While the majority of foreign branches will have well-established AML-CTF programs, they're often based on a global policy designed by an overseas-based head office. Some foreign bank branches customise their programs to the Australian environment. However, there are others who do not, and this can impede their ability to detect and report suspicious transactions that are specific to the Australian context. Foreign bank branches will continue to pose a medium money laundering vulnerability over the next 3 years. The level of vulnerability is unlikely to increase in the short to medium term due to the limited access to the subsector, the level of expertise required to exploit its products, and the long-term persistence of its corporate-focused business model. Now back to Nick, who'll take us through banking channel vulnerabilities.
Thank you, Michelle. Well, so the risk assessment found that money laundering endures through channels with the capacity to process high volumes of cash, including the banking sector. Cash is therefore a mainstay of money laundering in Australia and is one of the most commonly restrained, fortified, or frozen asset types in criminal asset confiscation matters. Domestic criminals continue to exploit cash as a value transfer mechanism using entrenched and highly effective methods that remain resilient to disruption. Accepting significant cash payments makes banks particularly vulnerable to exploitation, and cash-intensive businesses are assessed as posing a high and stable money laundering vulnerability. Next, I'll discuss legal structures, which are assessed as posing a high and stable money laundering vulnerability. This includes various types of companies and trusts. The misuse of legal structures is frequently and persistently observed in Australian money laundering investigations, exploited by criminals to store and move large volumes of criminal proceeds, including offshore. Offshore legal structures can help further obscure financial flows and beneficial ownership, particularly when legal structures are established in secrecy jurisdictions or across multiple jurisdictions. Legal structures can be established with relative ease and can mask the beneficial ownership of that as well. Complex legal structures can be established through various lawful activities, including but not limited to the use of parent and subsidiary entities, holding companies, joint ventures. The establishment of trust, trading and operational business accounts, as well as agreements and line of credit, and the use of financial and legal instruments, for example, power of attorneys, deeds, and contracts. Uncovering ownership and control of legal structures is challenging for law enforcement agencies and reporting entities. Criminals hide their assets behind various types and layers of legal structures to conceal true ownership and avoid confiscation. This is another reason why reporting entities must identify the beneficial owners of their customers and assess the money laundering risk they pose. Common money laundering activities observed amongst legal structures include placing cash into bank accounts held by legal structures to commingled funds, rapid layering of funds between domestic and foreign legal structures to obscure the true source or provide legitimacy to offshore funds transfers. The last stage of money laundering process is integration of funds. Legal structures are used to purchase or invest in high-value assets such as real estate. You should ensure your risk assessment, customer due diligence, and enhanced customer due diligence, as well as transaction monitoring program, are designed to identify and report these activities to AUSTRAC. Finally, trusted insiders. They are assessed as posing medium to stable money laundering vulnerability. Trusted insiders are individuals who misuse their legitimate access to an organization's service, products, information, or facilities for unauthorized or illegal purposes. Regulated industries with the capacity to process high volumes of funds, such as banks, are attractive channels for criminals to source or place trusted insiders. Criminals use trusted insiders to source funds, move cash, falsify documentation, and provide advice on how to evading law enforcement and regulatory detention. And trusted insiders can undermine or subvert their organization's AML/CTF controls. Trusted insiders will continue to pose a medium money laundering vulnerability over the next 3 years, given their critical links to legitimate services and markets. These findings highlight the significance of your employee due diligence program, which must be based on a MLTF risk assessment of your business, including the roles your employee perform. You must have an employee due diligence program which documents how you will screen and rescreen your employees and contractors for money laundering or terrorism financing risks to protect your business. Before we move on, I would like to pause and remind you to read the Money Laundering National Risk Assessment, as there are other sectors and channels included that we haven't discussed today, which may be relevant to your business. Some of these may not be rated as high risk, but may be assessed as increasing risk. Despite a sustained focus and effort across Australia, money laundering remains an intractable issue as it's highly intertwined with all profit-generating crimes. Australia remains committed to creating a hostile environment for criminal actors who abuse the financial system for money laundering. The National Risk Assessment provides further details on key judgments, factors, and features to help you assess these money laundering threats and vulnerabilities. Michelle will now take you through the terrorism financing sector section of this webinar.
Thanks again, Nick. So, as with money laundering, Australia is committed to ensuring our country and its financial system are resilient in preventing the financing and support of terrorism, both nationally and overseas. Australia combats terrorism financing through a well-established, robust counter-terrorism financing regime, which forms an important part of the country's national approach to countering terrorism and violent extremism in all forms. The Terrorism Financing in Australia National Risk Assessment is Australia's second comprehensive national risk assessment focused on terrorism financing, with the last report of this scale being completed in 2014. This risk assessment brings together insights to assess the risk associated with the methods and channels identified to finance and support terrorism activity. In November of 2022, Australia's national terrorism threat level was lowered to possible. The Director General of ASIO noted that espionage and foreign interference now replace terrorism as the country's principal security concerns, with the number of violent extremists who have both the intention and capability to undertake terrorist attacks in Australia having decreased. Some of the key features of Australia's terrorism financing environment detailed in the risk assessments are: Australian domestic terrorism financing environment remains small scale and low value. The Australian terrorism environment is largely characterised by small scale terrorism financing fund flows to offshore terrorist organisations and affiliated groups. Terrorism financing remains difficult to detect, and terrorists and their financiers largely continue to employ the same established methods of raising and moving funds. Financiers prefer readily available and proven methods to move funds, such as banking, remittance, and the exchange of cash over more complex schemes. Non-bank online payment service providers play an increasingly important role in the terrorism financing payment chain, as they facilitate many payments for platforms in the online funding ecosystem. And lastly, there has been an increase in the use of digital currencies. The terrorism financing process generally involves three distinct stages. Number one is raising funds through donations, self-funding, legitimate business or criminal activity. And number two is moving funds to a terrorist network, organisation, cell or individual, or between such entities, including the storage of funds. And number three is using the funds for direct operational and indirect organisational costs associated with terrorist activity. Nick will now talk about some of the key vulnerabilities identified for raising funds and moving funds.
Thank you, Michelle. You'll see in the table on this slide, there is a list of channels and methods used for raising funds. We've only included those rated medium risk or above. However, noting many of these methods may intersect with the banking sector at some stage, I'd encourage you to review the additional channels and methods included in the risk assessment. For each of these, the table shows how the level of risk has changed since the release of the Terrorism Financing Regional Risk Assessment in 2016. A risk rating of the current overall assessment for religiously and ideologically motivated actors being high, medium, low, and very low, and an assessment on how the risk is likely to change over the next 3 years. A risk may be assessed as dynamic if it's likely to change, but the trajectory is undetermined and largely dependent on external drivers. Self-funding remains the main method of ideologically and religiously terrorism financing in Australia and is assessed as high risk, which has remained stable since 2016. It generally involves very low to low value transactions, for example, between $5 and a few $1,000. This and the fact that the funds are almost sourced through legitimate activity makes it very difficult to detect and distinguish from ordinary behavior. The overall risk that social media, communication applications, and crowdfunding platforms are used by Australian violent extremists to connect, inspire, and raise funds is also assessed as high. The level of risk has increased since 2016, driven by product availability and greater uptake. This refers to the misuse of social networking and content hosting platforms, internet communication applications, and crowdfunding platforms used by violent extremists. Payments can be made in the online funding ecosystem in a number of ways, including transfers or deposits into nominated bank or remittance accounts, contributions made directly through platforms in the ecosystem, which are facilitated by online payment service providers or transfer of digital currency. Finally, the overall risk that Australian registered charities and legitimate non-profit organizations, also known as NPOs, are used to raise or divert funds for terrorism financing is assessed as medium. This has remained largely stable since Australia's sector risk assessment in 2017. Suspected terrorism financing plots involving legitimate NPOs have largely involved simple methods from raising and moving funds overseas. Donations are accepted by direct bank transfers, online payment service providers, cash, and increasingly digital currency. Traditional banking and remittance service providers are commonly used to move funds overseas. Informal remittance channels such as Hawala and cash couriering are also used to a lesser extent, particularly by NPOs that have been de-risked by major financial institutions. The risk assessment contains further information about fundraising methodologies, including the use of fraudulent campaigns where donors may be unaware of the intended illicit purpose of the funds. We encourage you to review the content in the National Risk Assessment in order to ensure that relevant indicators are reflected in your transaction monitoring program. Next, we look at moving funds. The current overall risk rating of the banking system being used to move and store funds for terrorism financing is assessed as high. The level of risk has remained stable since 2016 as banks continue to be a reliable and efficient way to move funds nationally and globally by threat actors. Again, most terrorism financing activity will intersect with the banking sector at some point in the transactional chain. So I'd encourage you to review other channels and methods listed in the risk assessment. Major banks are almost certainly exposed to the majority of terrorism financing risk facing the sector given the size of their customer base, scale of operations, cash transaction infrastructure, and global reach. They are also the key conduit for international transactions in and out of Australia and serve as correspondent banks for the other financial institutions. These links to offshore institutions and customers expose major banks to a higher level of foreign jurisdiction risk. Terrorism financing risk is concentrated in retail banking, which is exposed to high volumes of low-value transactions. Again, transactional accounts and electronic funds transfers are particularly attractive for terrorism financing as they allow rapid, reliable, and easy collection and storage and movement of funds nationally and globally. Transaction accounts are the most commonly and persistently misused product. They are easy to open, can often be established online, and are highly exposed to cash transactions, including the withdrawal of cash in high-risk jurisdictions. Misuse of store value cards and credit cards has declined in recent years as fewer Australians are travelling overseas to participate in foreign conflicts. However, terrorism financing risk associated with these types of product is dynamic and will likely shift in line with the threats of the landscape. Most terrorism financing cases involve simple, unsophisticated methods such as low-value customer-to-customer transfers. Some have involved structured deposits of cash or multiple domestic transfers into bank accounts, including pooling and storing of funds, followed by international funds transfers out of Australia. Retail banking products and services will remain attractive to terrorist financiers for the same reason they appeal to regular customers. They are fast, reliable channel to move funds domestically and overseas. I'll now hand you over back to Michelle to take us through the remainder of this presentation.
Thanks once again, Nick. Now, in December of 2022, AUSTRAC published a national risk assessment on proliferation financing. The results of this risk assessment found that Australia is primarily targeted by state-based or linked procurement networks that wish to exploit a range of sectors to export restricted, sensitive, or dual-use goods and knowledge. Procurement networks targeting Australia operate on behalf of the Democratic People's Republic of Korea and Iran, as well as other countries of proliferation concern. Other significant proliferation financing threats include the use of third country nationals to facilitate proliferation financing and evade sanctions, and the exploitation of Australian citizens to source and export sensitive technologies and knowledge for the use by actors of proliferation concern. All reporting entities must have risk-based systems and controls in their transaction monitoring programs to identify and report suspicious matters. This includes monitoring for suspicions that individuals or businesses are attempting to avoid Australia's sanctions laws in connection with the provision of a designated service or a request to provide a designated service. I encourage you to take the time to read the Proliferation Financing National Risk Assessment for a more fulsome picture of the threats and vulnerabilities identified and how these may relate to your business. Again, you must take into account AUSTRAC guidance and feedback that's relevant to your business's money laundering and terrorism financing risks when developing or updating your business's money laundering and terrorism financing risk assessment. AUSTRAC recently published updated guidance on taking AUSTRAC guidance and feedback on MLTF risks into account to help you assess your money laundering and terrorism financing and proliferation financing risks. The updates include the range of guidance products that AUSTRAC publishes on these risks. As discussed previously, the National Risk Assessments made several judgments in relation to the effectiveness of the banking sector's AML-CTF frameworks. For example, the potential lack of resourcing in some subsectors and the wide variation in the effectiveness of AML-CTF controls amongst other subsectors. Having a robust AML-CTF framework in place, including an up-to-date risk assessment, a strong transaction monitoring program, and an AML-CTF program tailored to the Australian environment will help you mitigate and manage your money laundering, terrorism financing, and proliferation financing risks and protect your business and customers. I encourage you to take the time to read this guidance, as well as the national risk assessments, to ensure you understand your business's risk assessment obligations, your money laundering, terrorism financing, and proliferation financing risks, and the relevant AUSTRAC guidance and feedback that you need to consider. We'd like to thank you once again for joining us, and we hope that you found this session informative and valuable. To access the national risk assessments or to find out more about your obligations, you can visit our website at www.austrac.gov.au. Thank you.